The world is obsessed with American debt. Cable news panels, presidential campaigns, TikTok financial gurus. Everyone's talking about America's debt crisis. But what if the real bomb is ticking? In Beijing. Because while US debt is loud, visible, and debated non-stop, China's debt is silent, concealed, and arguably far, far bigger. Officially, China looks fiscally responsible. A debt-to-GDP ratio under 90%. Strong growth, balanced books. But peel back the layers, and you'll find a shadow ecosystem of local government debt, state-owned enterprise borrowing, and unofficial liabilities that dwarf even Washington's excesses. In fact, China's real debt may be 300%, even 400% of its GDP. Not just worse than America's, but systemically opaque and potentially global in its consequences. So, what is China hiding, and how did the world's second largest economy become so quietly indebted? Let's begin. On paper, it seems clear. America is deeper in debt. The US government owes over $34 trillion, or about 123% of its GDP. It's front-page news. It sparks political standoffs and budget crises, and it's reflected in the country's AA+ credit rating. Now look at China. Its official central government debt is just 84% of GDP. Its borrowing costs are even lower than America's. And ratings agencies like S&P still give China an A+ rating. Seems fiscally sound. Until you realize that what's on the books in Beijing is only the tip of the iceberg. The real borrowing, the dangerous kind, is happening in the shadows. Let's start with the worst-kept secret in Chinese finance. Local government financing vehicles, or LGFVs. These are state-created shell companies run by local officials, backed by government land, and used to borrow billions from banks or issue bonds. Off the books, their mission: build infrastructure, create growth, hit quotas, bridges, roads, stadiums, malls, entire districts. Even if no one uses them, in theory, they're clever. In practice, they're dangerous. Here's how it works. China's local governments aren't allowed to borrow directly. So they set up separate companies, shell entities with names like Urban Development Group or Investment Holding Co. These LGFVs then borrow money from banks or issue bonds, technically not government debt, but backed by government land or future tax revenue. They build infrastructure, they stimulate growth, and they help officials hit Beijing's GDP growth targets. But none of this debt appears on official balance sheets, which makes China's debt appear smaller than it really is. How much are we talking? According to the IMF and several Chinese research firms, local governments owe at least $12.6 trillion through LGFVs. That's over 76% of China's GDP. And remember, that's just local governments. Not central, not state-owned enterprises, not households. All of this was built by LGFVs. So were hundreds of stadiums, bridges, science parks, and office districts, many of them now empty. In one province, Guizhou, the debt is so high, local officials publicly asked Beijing for help in 2023. The response? Figure it out yourself. Compare this with the United States. US state and municipal debt totals around $2.2 trillion, or just 12% of GDP, and it's fully transparent. Every municipal bond is registered, rated, and regulated. In China, many LGFV bonds are unrated, some are traded OTC, and others are simply rolled over indefinitely. And that's the gamble. If growth continues, the debt pays for itself. But if growth slows, the repayments collapse. And that's exactly what's happening now. Beyond local governments, there's another powerful borrower in China: state-owned enterprises, or SOEs. Officially, China has around 391,000 state-owned firms, with over 1 million more that are partially state-owned. These companies operate everything from telecoms and shipping to mining, railways, energy, and construction. Their mission: build, expand, obey. These are not private firms maximizing profit. They're extensions of state policy, and they borrow heavily, often at below-market rates, to do what the government asks. Estimates vary, but most analysts agree. SOEs hold over $30 trillion in debt. That's larger than China's GDP. Take the China State Construction Engineering Corporation, one of the largest construction companies on Earth. With over 360,000 employees, It's built airports, stadiums, entire cities, but it's also deeply leveraged. It thrives because the state backs its loans, buys its services, and protects it from competition. And here's the dilemma. These companies are too profitable to reform, too obedient to criticize, and too indebted to fail. If even a fraction of state-owned enterprises began defaulting, the government would be forced to intervene, converting corporate debt into public debt overnight. Meaning, much of this private debt is really implicit state debt. It just hasn't been accounted for yet. The problem isn't just the debt, it's the scale, the opacity, and the illusion of independence. These enterprises are the gears of China's economy, but they run on borrowed oil, and no one's sure how long the engine can keep going without overheating. Debt to GDP. It's the go-to metric for judging a country's financial health. But what if the GDP part is fake? For years, international economists and auditors have questioned the accuracy of China's GDP figures, and the core issue isn't technical, it's political. China's provinces are under intense pressure to meet or exceed national growth targets. So, local officials, who are judged and promoted based on GDP performance, often inflate numbers through questionable accounting, repeated asset revaluations, and make-work infrastructure projects. In some cases, entire provincial GDPs were exposed as falsified. One infamous example, Liaoning Province. In 2017, it admitted to faking fiscal data for years, inflating revenues by over 20% to meet Beijing's mandates. And Liaoning wasn't alone. Several provinces, including Inner Mongolia, Tianjin, and Jilin, have been accused of similar manipulations. So, how big is the real Chinese economy? Some independent economists estimate it could be 20 to 60% smaller than officially reported. If true, that would push China's actual debt to GDP ratio as high as 450%, placing it among the most over-leveraged economies on Earth. It's like hiding a skyscraper behind a painted fence. The numbers may look strong, but beneath the surface, there may be less economy and more debt than anyone wants to admit. Here's the paradox. With all this hidden debt, you'd expect China to face sky-high borrowing costs, a downgraded credit rating, or even bond market panic. Instead, China still enjoys A+ credit ratings. Its 10-year government bond yields hover around 1.7%, compared to 4.5% for the United States. So what gives? The answer lies in a carefully engineered ecosystem of capital controls, market restrictions, and limited alternatives. Let's break it down. First, foreign capital can't flow freely in or out of China. The yuan isn't fully convertible, and Beijing tightly manages exchange rates. This means Chinese investors, especially banks, pension funds, and insurance firms, can't easily diversify into US treasuries or European bonds. Instead, they're nudged or outright required to park their funds in Chinese government bonds. Second, the Chinese financial market is illiquid and insulated. It's not a free marketplace where fear drives yields higher. It's a system where most debt is held by state-owned banks, who continue buying government paper regardless of risk, because it's mandated, safe, and patriotic. Third, the government has extraordinary tools to suppress volatility. Bond sell-offs, halted, rate spikes, controlled, bank collapses, absorbed. So while the rest of the world uses market signals to price risk, China uses bureaucracy. This creates an illusion of financial health. Low yields suggest low risk, but in reality, it's not investor confidence driving the rates down. It's lack of freedom to choose otherwise. China's borrowing costs are low, but not because the debt is safe, because there's nowhere else to go. Real estate is the largest asset class in the world, bigger than stocks, bonds, and gold combined, and no country has gone bigger than China. For decades, China poured its growth into property, skyscrapers, condos, industrial parks, mega developments. The country now builds more square footage every year than the US, Europe, and Japan combined. And the result? Real estate now accounts for nearly 30% of China's GDP. Far higher than almost any other major economy. But this isn't just economic policy, it's personal. For the Chinese middle class, property became the ultimate store of value. 70% of household wealth is locked in real estate. It's how families save. It's their legacy, it's their retirement. And prices reflect that emotion. In Beijing, the average home now costs over 35 times the average annual salary. To put that in perspective, in New York, it's 10x, in London, 13x, in Tokyo, 11x, in China, it's 35x. But demand hasn't caught up. Millions of homes remain empty. Entire cities, fully built, remain uninhabited. These are the ghost cities. From Ordos in Inner Mongolia to Ujiapu in Tianjin, once billed as China's Manhattan, and now the cracks are showing. Developers like Evergrande, once the second largest in the country, collapsed under more than $300 billion in liabilities, defaulted bonds, suspended projects, angry buyers, and a chilling realization: the market may not be able to bounce back. And here's the domino effect. With prices falling, families feel poorer. With unfinished homes, buyers stop paying mortgages. With weak demand, developers stop building. With no construction, workers lose jobs. And when people feel poorer, they spend less, which brings us to the next silent threat. For the past 25 years, China has enjoyed low and stable prices. But lately, that stability has turned into something far more dangerous: deflation. Prices aren't just flat in many categories, they're falling. On the surface, that sounds good. Cheaper food, cheaper electronics, cheaper everything. But deflation is not a discount. It's a signal, a symptom. In a healthy economy, prices rise slowly, around 2% per year. That reflects confidence, growth, and investment. But in China, falling prices suggest the opposite: overproduction, weak demand, and growing fear. Households are hoarding savings. Corporations are postponing investments. Youth unemployment is at record high. In 2023, household consumption accounted for just 39% of China's GDP, compared to 68% in the United States. Stimulus packages haven't worked. Tax cuts haven't worked. Even slashing mortgage rates hasn't worked. Because this isn't just a policy failure. It's a psychological shift. People no longer believe that tomorrow will be richer than today, so they save and wait. And the economy stalls further. Insight: deflation disincentivizes investment and fuels stagnation. China now finds itself in a paradox. It produces everything, but consumes almost nothing. And in a system driven by production, that imbalance is more than an economic problem. It's an existential one. In 2022, something happened in China that hadn't occurred in over 60 years. The population shrank, not slowed, not plateaued, shrank. It marked the first population decline since the Great Famine of 1961. China is now entering a new era, one of demographic gravity. The country's one-child policy, enforced from 1980 to 2016, achieved its goal. It controlled population growth. But the cost? A rapidly aging society, a shrinking labor force, and a declining consumer base. Right now, 17% of China's population is over 60. By 2050, it will be over 35%, 1 in every 3 people. The implications are profound. China's economic miracle was powered by cheap, abundant labor, hundreds of millions moving from rural farms to urban factories. But now, that engine is slowing. The working-age population peaked in 2011 and has been declining ever since. This means fewer workers producing goods, fewer taxpayers funding pensions, and fewer young people buying homes, cars, or consumer goods. Meanwhile, pension liabilities are exploding. By 2035, China's national pension fund is projected to run out of money unless drastic reforms are made. And unlike the US, China can't rely on mass immigration to fill the gap. It's culturally resistant and politically complicated. This is the demographic trap. Lower growth, lower demand, higher debt, and no young generation to climb out of the hole. It's not just economic slowdown, it's a structural shift. The gravity is real, and it's pulling China's future downward. The question isn't just what happens to China, it's what happens to the rest of us if China's debt spiral spins out of control. First, supply chains. China is the world's factory, accounting for over 28% of global manufacturing output. A debt crisis that hits state-owned enterprises or exporters could trigger global shortages, from semiconductors to solar panels. Next, commodity demand. China consumes over 50% of the world's copper, 60% of its iron ore, and nearly 30% of its oil imports. If China slows dramatically, commodity prices collapse. Emerging economies from Brazil to Nigeria to Australia feel the shock. Then comes real estate contagion. Many global investors, including major Western hedge funds, pension firms, and banks, were exposed to Chinese property bonds. Evergrande's default alone rippled through offshore markets, wiping out billions. A broader collapse could trigger a bondholder panic, especially in Asia. And finally, the confidence crisis. If the world's second-largest economy can't manage its debt, investors will begin questioning other emerging markets: India, Turkey, South Africa, Indonesia. The dollar could strengthen rapidly, capital flight would intensify, and global growth would suffer. In a globalized world, China's slowdown isn't contained. It radiates outward through trade, finance, psychology. And while it may not collapse overnight, each crack in the facade sends tremors through the system. The world built its future on China's rise. But what happens if that future was financed on silent debt?